A comprehensive list of interesting facts about banks. Definition: banks are financial institutions that accept deposits, provide loans, and offer other financial services. History: the first known bank, Banca Monte dei Paschi di Siena, was founded in Italy in 1472. Types of banks: there are several types, including commercial banks, investment banks, credit unions, and central banks. Central banks. Central banks, like the Federal Reserve in the US, manage a country's currency and monetary policy. Reserve requirement: central banks require commercial banks to hold a certain percentage of deposits as reserves. Interest rates: banks charge interest on loans and pay interest on deposits, which is a key part of their profit model. Fractional reserve banking: this system allows banks to lend out most of the deposits they receive, keeping only a fraction in reserve. FDIC insurance: in the US, the Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per account holder. Mobile banking: the rise of technology has led to the growth of mobile banking, allowing customers to manage their accounts from smartphones. ATM networks: automated teller machines, ATMs, allow customers to withdraw cash, check balances, and deposit money outside bank hours. Online banking: many banks offer online banking services, enabling customers to perform transactions over the internet. SWIFT network: the Society for Worldwide Interbank Financial Telecommunication, SWIFT, enables secure international money transfers. Loan types: banks offer various loans, including personal loans, mortgages, auto loans, and business loans. Credit rating: banks assess the creditworthiness of borrowers using credit scores, which impact loan approval and interest rates. Regulations: banks are heavily regulated to ensure stability, protect depositors, and prevent fraud. Monetary policy: central banks use tools like interest rate adjustments and open market operations to influence economic activity. Banking crisis: economic downturns can lead to banking crises, where banks fail due to bad loans and insufficient capital. Investment banking: investment banks assist companies in raising capital through stock and bond offerings and provide advisory services for mergers and acquisitions. Credit unions: these member-owned financial cooperatives typically offer lower fees and better interest rates than traditional banks. Microfinance: some banks specialize in providing small loans to entrepreneurs in developing countries, promoting economic growth. Green banking: this refers to banking practices that promote environmentally friendly initiatives, such as funding renewable energy projects. Bank fees: banks often charge fees for services like account maintenance, overdrafts, and ATM usage. Foreign exchange: banks facilitate currency exchange, allowing individuals and businesses to conduct international trade. Digital wallets: services like PayPal and Apple Pay allow users to make transactions online or via mobile devices. Bailouts: during financial crises, governments may provide bailouts to prevent banks from collapsing and to stabilize the economy. Bank secrecy: some countries have laws that protect the privacy of bank account holders, often attracting foreign deposits. Interest rate spread: the difference between the interest rates banks pay on deposits and what they charge on loans is known as the interest rate spread. Sustainable banking: some banks focus on sustainability, offering green loans and investing in socially responsible projects. Blockchain technology: emerging technology that could revolutionize banking by providing secure and transparent transaction methods. Anti-money laundering (AML) regulations designed to prevent banks from being used to launder illicit funds. Know your customer (KYC), a process banks use to verify the identity of clients to prevent fraud and ensure compliance with regulations. Investment products: banks offer various investment options, including stocks, bonds, mutual funds, and retirement accounts. Private banking: tailored financial services offered to high net worth individuals, including investment management and estate planning. Mobile payments, growing popularity of contactless payments using smartphones, revolutionizing transactions. Credit default swaps, financial derivatives used by banks to manage risk, allowing them to insure against defaults on loans. Customer service. Many banks have 24/7 customer service support to assist with account-related inquiries. Merchant services. Banks provide payment processing services to businesses, enabling them to accept credit and debit card payments. Regulatory bodies. Various regulatory agencies oversee banking practices, including the OCC, FDIC, and CFPB in the U.S. economic impact. Banks play a critical role in economic development by providing loans for businesses and personal growth. Banking apps. Many banks have developed apps to help customers manage their finances easily from their devices. Digital transformation. Traditional banks are increasingly adopting digital solutions to compete with fintech companies. Bank runs occur when a large number of customers withdraw their deposits simultaneously due to fears of bank insolvency. Global banks. Large multinational banks, such as JP Morgan Chase and HSBC, operate in multiple countries and have significant global influence. Fintech. Financial technology companies are reshaping the banking landscape by offering innovative solutions and services. Asset management. Banks often have asset management divisions that help clients manage their investment portfolios. Risk management. Banks use various strategies to mitigate financial risks, including diversification and hedging. Consumer protection. Regulations exist to protect consumers from unfair banking practices, such as predatory lending. Islamic banking, a banking system that operates according to Islamic law, prohibiting interest and investing in non-compliant industries. Community banks, smaller banks that focus on serving local communities and providing personalized services. Underbanked populations. Many individuals and communities have limited access to traditional banking services, prompting alternative solutions. Credit counseling. Some banks offer financial education and counseling services to help customers manage debt. Savings accounts. These accounts typically offer interest on deposits, encouraging individuals to save money. Merchant loans. Banks provide financing options specifically designed for small businesses to manage cash flow and inventory. Overdraft protection, a service that allows customers to withdraw more money than they have in their accounts, often for a fee. Banking regulations. Laws like the Dodd-Frank Act in the US were enacted to promote financial stability and consumer protection. Trust services. Banks often provide trust services, managing assets on behalf of clients for estate planning and wealth management. Payment systems. Banks facilitate various payment systems, including ARC, automated clearinghouse, and wire transfers. Digital currency. Central banks are exploring digital currencies, CBDCs, as a response to the rise of cryptocurrencies. Cross-border banking. International banks provide services to facilitate cross-border transactions and investments. Financial literacy. Many banks promote financial literacy initiatives to educate customers about managing their finances. Blockchain adoption. Some banks are experimenting with blockchain technology for secure transaction processing and record keeping. Consumer loans, personal loans, student loans, and home equity loans are common products offered by banks. Economic indicators. Banks monitor various economic indicators, such as inflation and employment rates, to inform their lending practices. Depository institutions. Banks fall under the category of depository institutions, which accept deposits from customers. Securitization. Banks bundle loans into securities, which can be sold to investors, spreading risk and providing liquidity. Credit scoring. Credit bureaus calculate credit scores based on an individual's credit history, influencing loan approvals. Overseas branches. Many banks operate branches in other countries to serve international clients and facilitate global transactions. Risk-based pricing. Banks may adjust interest rates based on the perceived risk associated with a borrower. Virtual banking. Fully digital banks operate without physical branches, providing services exclusively online. ATM skimming. A form of fraud where criminals use devices to capture card information from ATMs. Cash management. Banks offer cash management services to businesses, optimizing their liquidity and cash flow. Deposit accounts. Banks provide various deposit accounts, including checking, savings, and certificates of deposit, CDs. Bank mergers. The banking industry often experiences mergers and acquisitions to enhance competitiveness and market share. Non-performing loans. Loans that are in default or close to being in default can impact a bank's financial health. Bank codes. Each bank has a unique code, like IBAN or SWIFT, used for international transactions. Financial inclusion. Banks are increasingly focused on improving access to financial services for underserved populations. Customer loyalty programs. Some banks offer rewards programs to encourage customer retention and engagement. Peer-to-peer lending. A model that connects borrowers with individual lenders, bypassing traditional banks. Identity theft protection. Many banks provide services to protect customers from identity theft and fraud. Interest rate risk. Banks face risks associated with fluctuating interest rates, impacting loan profitability. Cashless societies. Some countries are moving towards cashless societies, relying on digital payments instead of cash.